What is EBITDA and why is it used? And stick around to the end of this video. We'll talk about one particular strategy that we implement relative to EBITDA to maximize values for the companies that we're either selling or securing capital for. So what is EBITDA? Oftentimes people talk about a company being worth a multiple of its profit, a multiple of its net income. But in reality, the specific metric that most valuations are predicated on is a multiple of EBITDA. And EBITDA stands for, we'll get a nice graphic here, earnings before interest, taxes, depreciation, and amortization. So when you look at the P&L or the income statement for a particular business, it starts with revenue, it goes through the cost of goods sold, gross profits, operating expenses, down to net income, net ordinary income, net operating income, whatever the metric is used. And that's a kind of starting point for what EBITDA is. And so if you say, well, why wouldn't we just use net income? Because really a business is valued on its cash flowing ability. And so not necessarily its accounting income, but instead how much cash is coming out of the business every day. And there are expenses in the operating expenses and elsewhere on the income statement that are non-cash expenses that would incorrectly show a lower cash flowing ability of a business. You might hear 6 times, right? You want that applied to a higher number to create a higher product of that multiplication problem, right? And so if the net income of a business is $2 million and you apply a 6 times multiple to it, you have a value of $12 million. However, if the EBITDA of the business, which is a better and more accurate gauge of the cash flowing abilities of the business, is say 2.5 times because there's non-cash items, then 6 times 2.5 times is $15 million. So meaningful value accretion there from the same numbers. And so it's important to characterize the numbers appropriately and to add these things back. So let's walk through each component of EBITDA. So first you have earnings before. So that means we're going to add back certain non-cash and irrelevant items for future ownership to the net income number. And so the first of these is interest. And someone might say, well, you have to pay interest with cash. That is true. However, the capitalization of the business or how much debt you have on a particular business or anyone has on a particular business is very unique to the owner. And so when we're looking at the cash flowing ability of a business, we want to say how much cash does it throw off in an unlevered scenario? That is a situation where it has no debt. And so if a company is generating $2 million a year in net income, however, there's $500,000 of interest on debt, as again for round numbers, then if someone else were to buy the company and it were to have no debt, because oftentimes the purchase price has to be used to pay off debt, think of like a home mortgage, then it would really generate $2.5 million to that new person. So that's the first item. The second is taxes. And so sometimes people will look at, and this is more for publicly traded companies, they'll look at the post-tax income of a business, and it's not necessarily the most accurate gauge of cash flowing abilities because everyone's tax situation is going to be different. Some people are going to be C Corps, S Corps, LLCs filing as S Corps. I mean, there's a lot of different variations in partnerships and how that tax burden is. And so it's better to look at things from a pre-tax perspective because, again, now it's still focusing on the fundamentals of the business, not on any unique characteristics of any particular owner or prospective owner of the business. Next is depreciation and amortization. Both are largely tax vehicles. And so if you were to buy a building, for instance, there's a certain amount of duration at which you can depreciate the cost. And so the tax idea of depreciation is that you can take the expenses, instead of expensing it all day one for tax purposes, you can expense whether building equipment, other items on it that you purchase to run a business over the lifespan of the business. And so from an accounting perspective, this is a way of kind of allocating the tax savings or the useful life of something over a certain amount of years. However, depreciation is not a cash expense. And so it's a tax shield in the sense that it shows up as an expense on the income statement. However, it's not cash that comes out of your pocket every year. And therefore, if you're really, again, looking at the cash flow generating power of a business, you want to add back that depreciation. And amortization is the same thing, but instead of hard assets, it's the more intangible. So if you acquire a business and pay a certain amount for all of its assets, but then a premium for it, that will show up on a balance sheet as goodwill. Right? And there's other examples of things that can be amortized, but goodwill is often something that when people acquire a business, they amortize the goodwill of that purchase over, again, a fixed amount of time based on tax laws to, again, create a non-cash expense that lowers the taxable income. However, being that it's non-cash, it artificially lowers the cash flow from the business. And so you want to add back the amortization. And so think of depreciation as hard asset, non-cash expenses. Amortization is more intangible. Amortization, exceptions to both, of course, but adding those back to EBITDA ultimately, again, creates a truer proxy for the cash flow generating power of a business. And so at the end of the day, you say you have earnings, net income, adding back interest, because again, capitalization of the business is unique to everyone, and we want to look at it on an unlevered basis. Taxes, because that's going to be unique as well. We want to look at pre-tax. Depreciation, because those are non-cash expenses. Amortization, because those are non-tax expenses. And that gives you EBITDA, a truer proxy, not perfect, but a truer proxy of the cash flow generating power of business, and when applied for a particular multiple, creates a higher value. And so getting to the tip or strategy or secret that we like to use, or that's part of every one of our exercises, is we further go through the EBITDA to create what we call a recasted or adjusted EBITDA, looking at beyond kind of the traditional add backs, but other items that are non-recurring, that are either non-recurring in nature because they were one-offs, or they're non-recurring in nature because they're likely to be different. For instance, if your company generates $2 million in profit a year, however, you pay yourself a salary of $1 million a year, whereas someone who is not you or the owner of the business may be able to perform the same duties at $150,000 a year, then there's $850,000 of excess executive compensation that would be added back for the new owners of the business. Because if you leave the business and they can hire someone for $150,000 instead of $1 million, then it's really making $2.85 million, right? So that's just one example, but there's others as well, whether there's any kinds of personal expenses, whether there's kinds of one-off non-recurring elements to a business, of a unit shutdown, of a particular lawsuit, of whatever it is. But the purpose of the recasted EBITDA or the adjusted EBITDA is to show on a prospective basis what the cash flow generating power of the business will be going forward. Look, this is a negotiated point, and in every kind of offer being negotiated, it is going to have a push and pull and sometimes a compromise in some of these items. However, if you think of the steps from going from net income to EBITDA to further a recasted or adjusted EBITDA to truly show the most accurate gauge of the cash flow generating power of a business, that's what we want to apply to a multiple, and that can be meaningfully different. Adjusted EBITDA versus net income could be 50% higher given the particular situation, and so multiply that by the same multiple, and obviously the valuation is considerably higher as well. So that's something that we undertake with all of our clients across the board in every single engagement, again, to maximize value among some of the other salient variables for a transaction. So that's the thought for today. Keep pushing forward. Hope the week continues to go well. God bless. We'll see you next time.